deferred management fee. Our balance sheet reset is now complete with the full bank refinancing we announced at the start of the week. And we have today announced that we will hold an Investor Day in February, which will cover our strategy refresh and new capital management framework. Let me start with the first half highlights on slide 5. Starting with our sales performance, we've seen a rebuild in sales volumes for the first half with total sales of 704. While down on the second half of last year, which was a record, this was up on the fourth quarter of last year and is at a significantly higher value with the new level of DMF. On the operating side, we've stepped up the level of cost out. To 30 September, this is now $40 million annualised, and we've uplifted the full year target to $50 to $60 million. This is reflected in our financial performance, with a significant improvement in operating EBITDAF and positive free cash flow for the half of $56.2 million, with total revenue up 13% on both pricing and occupancy growth, while total costs fell 2%. We've completed the refinancing of all banking facilities, significantly extending the average facility tenor to 5 years. As part of this refinancing, we also improved our pricing and have more resilient financial covenants. Through the half, we completed an ASX foreign exempt listing, which we committed to do at the time of the capital raise. This is a pivotal step in expanding Ryman's investor base while reinforcing our commitment to the Australian market. Finally, we've made good progress with the strategy and portfolio review, with additional land divestments bringing total contracted sales to $110 million. We will be coming back to the market at an Investor Day in February with an update on our refreshed strategy and capital management framework going forward, including our dividend policy. Now jumping into the detail, starting with sales on slide 8. We've seen continued improvement in sales effectiveness and contract conversion, driven by strong lead generation from village open days and targeted sales and marketing initiatives. Looking at the first quarter, we saw a 12% step up and another 9% step up in the second quarter in our occupied sales. As a reminder, these are RV unit sales only, and we do not include care RADs in our sales numbers. This year we introduced quarterly reporting, so you already have the sales figures you see on this slide. The new news is the update to our full year guidance to 1,300 to 1,400 units, which I will speak to at the end of the outlooks in the outlook section. Moving now into pricing and the breakdown in sales mix. On slide 9, you can see the changes we made to the pricing model are now fully in place. As a reminder for those new to the Ryman story, our sales, which are recognised at the point of occupancy, typically lag contracting by 6 months on average. We made the shift to a standard 30% DMF on the 1st of October 2024, so contracts signed prior to that date have now been settled, and the first half of this year reflects the pricing changes. You can see that 3/4 of new residents are moving in on our standard 30% DMF, with the remaining quarter being a mix of DMF options, demonstrating the flexibility in our pricing framework across DMF and unit pricing to meet individual needs. Our contracts are long dated, and the benefit of these changes will build over time, with annual portfolio turnover currently at 12%. As well as the uplift in DMF, we're also seeing a significant step up in weekly fees, with an average 60% uplift in the level of weekly fees on rollover of units. Now moving now to sales contracts on slide 10. You can again see the significant improvement, half on half, coming through in our forward contract book, with both increased contracting levels and a reduction in cancellations. Market conditions are still mixed across the regions. We're seeing early signs of recovery in Victoria, while Auckland is yet to show meaningful improvement, which is significant for Ryman, with around 30% of the portfolio in Auckland. Our contracted level of stock is lower, reflecting the recent completion and settlement of pre-sold stock at Kevin Hickman and Nellie Melba. Stepping now into the breakdown between resales and new sales on slide 11. Our average resales pricing has been broadly stable, while slightly down half and half due to mix impact. Independent units are down 2% year on year, while serviced units are up 1%. We've seen our gross resales margin, which includes the cumulative capital gains on each unit, continue to moderate from the historical highs. This reflects the flat housing market we've experienced in recent years. We've seen resales volumes increase across both independent and serviced apartments compared to the prior half. But you will see there is still a gap between sales and turnover, 81 units for the half, which means, as we signalled at our full year results, there is a working capital drag through the half, with an increase in resale stock and the payout balance. Turnover is an important driver of cash generation in our model through both the DMF and capital gains. With improving resales, we have significant opportunity both to increase cash generation and to release cash from the $330 million of bought back stock we have today. Turning to new sales on slide 12. New sales have reduced, reflecting the planned ramp down in development in response to elevated industry stock in some locations. As a result, our level of new sales stock has remained broadly flat over the past 6 months. We do have elevated levels of serviced apartments following the opening of 5 main buildings over the last 18 months. As we refresh our strategy, we're looking at how our serviced apartment offering can best meet resident needs and respond to the current home care funding model. This will also allow us to unlock value from vacant stock. Average pricing remains strong, supported by a favourable mix, with 45% of new sales coming from Australia. And importantly, our total new sales stock value of around $470 million at the end of the half represents a significant cash release opportunity going forward. As we open the operations section on slide 14, I'm pleased to share that Ryman has once again received significant external recognition. I know these award slides sound a bit repetitive given how many we've won over the years, but this is ongoing recognition across both the aged care and retirement living parts of our business, which truly reinforces the strength of Ryman's reputation. Importantly, our internal customer survey results have also continued to improve year on year across all parts of the village. It's been especially pleasing to see this progress in a year where we've undertaken a significant reset across many areas of the business. And I want to acknowledge the dedication and commitment of our Ryman team members who work every day to deliver great service for our residents and are working to make our business performance even more sustainable. Moving now to aged care performance on slide 15. Starting with pricing, we have seen period on period improvement in both room premiums in New Zealand, up 10% on PCP, and in average refundable accommodation deposits, or RAD, balances in Australia, up 5%. These gains are in addition to the base care funding uplifts implemented in both New Zealand and Australia. In New Zealand, a base care funding uplift of 4% took effect from 1 July. In Australia, changes to allow a 2% annual retention of new RADs came into effect on the 1st of November. With our average incoming new RADs in Australia currently exceeding $800,000, this is expected to deliver a meaningful increase in revenue from new RADs moving forward. We have also successfully trialled a new product for residents transferring to care from within the village, which we are now rolling out across all of our New Zealand villages. This allows us to grow the level of resident capital in care in New Zealand and gives our residents more choice in how they fund the cost of their care. On the occupancy side, we are seeing growing utilisation, with average vacant beds in our developing villages reducing across the half. Mature village occupancy was impacted by a challenging winter, but we are seeing improvement as we head into the summer months. Our two oldest rest home level care centres in Christchurch were closed, timed to align with the opening of the new 80-bed facility at Kevin Hickman. This week marks the final stage of resident transitions from these villages, with each person supported into a new home that meets their needs. And this has also enabled a faster fill of the newly opened Kevin Hickman Care Centre. Moving on to slide 16 and the significant progress with aged care reforms across both Australia and New Zealand. Both countries continue to face two powerful demographic and economic forces, a structural housing shortage and a rapidly growing ageing population. In Australia, reforms have been enacted and are now moving into the implementation phase. From 1 October, updates to the Australian Aged Care Act strengthen the government's co-contribution funding model, with clinical care fully government funded and accommodation and living costs subject to means testing. Ryman is already well progressed in meeting the new clinical care minute requirements, which become mandatory with the new funding changes. We've also seen significant progress made in New Zealand, with the government announcing the establishment of a ministerial advisory group. While it is lagging Australia in undertaking the necessary reforms, we expect New Zealand will benefit from being able to draw on lessons from the Australian reforms, taking the elements that have worked well and delivered meaningful benefits while supporting the delivery of high-quality care without creating undue compliance burden. The New Zealand government has also been specific on the timing it wants to achieve, seeking the group's advice by the middle of next year to enable it to enact changes to the funding model in 2027. This will provide time for all political parties to commit to funding reform ahead of the New Zealand election next year, and there is a big focus on the reforms gaining bipartisan support, as occurred in Australia. Moving now on to development. Slide 18. I'm pleased to announce today the appointment of a new Chief Development and Property Officer. Blah, blah, blah. Have to fix that bit. Can't open my computer. Slide 18 reflects the status of our program of works across our in-flight projects. We've made good progress in the last half with the completion of the final stage at Nellie Melba, completing the village, the completion and opening of the Kevin Hickman main buildings, the commencement of the main buildings at Patrick Hogan, and progress of Keith Park stages 8 and 9, with these independent apartments forming the bulk of our second half build guidance. We expect updated plans for our Hubert Opperman village to be finalised and approved next calendar year, allowing for the commencement of construction, which will be the first project we deliver under the outsourced model. And we continue to have more than 300 RV units sitting in our land bank for future stages on these projects, which have planning approvals and are ready for development as and when market conditions support it. The next slide provides a snapshot of the 5 main buildings opened in the past 18 months, and you can see where we stand on occupancy for RV units and care at each of these villages. Moving on to our land bank on slide 20. In February, we announced that we were undertaking a comprehensive review of our land bank, which was independently valued at $376 million at 30 September. We have been exploring the best opportunities for growth in terms of both our existing villages and our greenfield sites, and also determining which sites would deliver better value for shareholders through divestment. A number of sites were identified for potential divestment during the early stages of this review, and we are pleased to report the successful sale of Park Terrace in Christchurch for $42 million and Mount Eliza in Victoria for $36 million. This is in addition to the existing contracted sales of Karori and surplus land at Nellie Melba, totalling $33 million, which are expected to settle before year end. We will provide a further update on our land bank review at our Investor Day in February, and expect to have identified sites to be retained for future development, as well as additional sites for divestment. Now I will hand over to Matt to run through the financials.
Thanks, Naomi. As my first half at Ryman, it has been fantastic getting to see the opportunity to unlock value in the business on a number of fronts, which I will touch on today. And as for the result, I'll talk to the financial highlights in our P&L, cash flow and valuations, as well as speak to the refinancing update, which we announced earlier in the week. Starting with slide 22. As Naomi has spoken to, we have made meaningful progress in the first half, which is reflected in these financial results. I'll call out 4 highlights on this slide. Firstly, we've seen a significant improvement in profitability, with profit before tax and fair value movements up 57.6 million year on year, driven by strong revenue growth of 13% and disciplined cost control. Next, free cash flow of 56.2 million was positive, underpinned by strong net development cash flows and lower finance costs. Thirdly, acknowledging the quality of our 1 billion of unrealised development assets, which sets up a material opportunity in future financial value. And lastly, the full refinancing of our bank debt, which has extended average tenor to 5 years, improved pricing, and introduced a fit-for-purpose covenant structure. The refinancing completes our balance sheet reset and provides a strong foundation to grow earnings. Moving to slide 24. Strong revenue growth is a notable highlight for the half, driven by the benefit of both our growing resident base, up 4% year on year in volume terms, and stronger pricing in both aged care fees and retirement village fees. Year-on-year growth in DMF revenue includes a one-off adjustment in the prior period from a historical GST issue, which was disclosed at the full-year result. Removing this impact, DMF was broadly flat year-on-year. There are a number of factors at play here, including the change to our pricing model, as well as the accounting changes made in FY25. If we look at the independent units, we have moved from a 20% to a 30% DMF, but with the recognition period changing from 7 years to 9 years. Similarly, serviced apartments have moved from the 20% to 30% DMF, but with recognition changing from 3 years to 4.5 years. This means that whilst the change in DMF contract terms is building a higher value contract book, it will take time to flow through the P&L, and this is shown in revenue in advance on this slide. In simple terms, revenue in advance represents DMF which has been contractually accrued but not yet recognised in the P&L. This will underpin DMF revenue growth in future periods. I would stress that our front book revenue profile across both DMF and weekly fees is significantly greater than the revenue in place from our back book, and this underpins growth in years to come. Slide 25 shows the significant progress we have made in our cost-out programs over the past year. Non-village expenses reduced half on half by 27% to 54 million, with the majority of this improvement coming from last year's restructure to support services. Adding to this is also some reallocation of costs to villages following operational changes. Village expenses increased 7%, reflecting additional capacity which has come online, noting that we have opened 5 main buildings in the past 18 months. While cost savings remains a key focus for the business, this has been approached in a very considered way, given the importance of the Ryman brand and our strong resident proposition. Moving to slide 26. Combining the revenue and cost improvements I've talked to, we have seen a 26.4 million year-on-year lift in operating EBITDAF to $40.1 million, a key measure we focus on internally to track the core operating performance of our villages. I would note that this does not include any realised capital gains on retirement village ORAs, which are reflected in other metrics, such as cash flow from existing operations. The chart on this slide shows the improvement, with the non-village cost reduction and positive leverage in developing village growth providing the most benefit. Moving to slide 27. A key strategic priority for FY26 has been the segmenting of our financials between aged care and retirement village parts of the business, which we'll report on going forward. I'd like to highlight that this is a non-GAAP disclosure, which currently sits outside of our financial statements. Segmentation is based on property type, with the aged care segment comprising our care centres and the retirement village segment comprising our independent living units, service apartments, as well as common areas and amenities. I should also make clear that home care services provided to residents in RV are included in the village segment. Central to this analysis is the allocation of support services to each of the segments. A substantial amount of support is provided through our office functions, such as operations, clinical, procurement, and contracting. Allocating these costs to the segments provides a complete picture of our cost structure and business performance. The output of this work provides metrics such as EBITDAF per aged care bed of approximately $15,000 on an annualised basis. For a scale operator such as Ryman, this is significantly below the full potential of our portfolio, and there are transformation projects underway to improve performance. It is also important to note that the figures shown on a per bed or unit metric are averages, with variations seen throughout the portfolio. Our transformation progress will be reflected in these segments going forward. Slide 28 details our cash flow from existing operations, which is down year on year when excluding interest. Robust cash flow from village operations, aligned with the improvement in operating EBITDAF, has been offset by lower net cash flow from resales. Resales cash flow continued to be impacted by growth in our bought back stock, which grew $53 million in the half. Excluding this, our cash performance would have been meaningfully higher. I'd also highlight that we have made some refinements to our cash flow methodology. The most significant change is the allocation of interest on unsold stock and land bank to development activities. Whilst much of this interest does not meet the criteria for capitalisation, functionally it still relates to our development business. Other changes include the allocation of sales and marketing costs between CFEO and CFDA, and similarly reallocating costs on land bank sites such as rates and site security to CFDA. The composition of CFEO shows the improvement in village operations, but this is held back by gross receipts from resales compared with the previous half, which had the benefit of stronger sales. Totaled against lower non-village expenses and attributed interest costs, there was a slight improvement in overall CFEO. Turning to slide 29, we have seen a strong net cash release from the development side of the business, as our project spend reduces significantly and we sell down existing stock. The opportunity to release cash from inventory is substantial, with approximately $470 million of new sales stock at 30 September. Consistent with my previous comments, the figures on this slide reflect our updated methodology with cost allocation to CFDA, including marketing and selling costs, as well as allocating notional interest on new stock and our land bank. Slide 30 shows the positive free cash flow for the half, which was the first time in many years for Ryman. Cash flow of $56 million was partly offset by a headwind of $42 million in other movements, primarily FX, with the 3% decline in the New Zealand dollar for the period. While this has had a negative impact on our Australian dollar debt, I'd note that our Australian dollar assets have also seen an FX uplift, which has an offsetting benefit to our balance sheet and NTA. And as Naomi has already highlighted, there have been subsequent land bank sales that will benefit our second half cash position. Turning to asset valuations on slide 31. Independent valuations across our sites consider unit and pricing information, capital spend, and site-specific factors, with further details in our presentation appendices. The half saw a positive fair value movement of $3.2 million, reflecting a number of changes including price, where the outcome was broadly flat, taking into account FX and the previous result adjustment. There was also a small impairment for 3 care centres, but with the overall investment property carrying value and net tangible asset value remaining broadly flat against the previous result. My final slide on financial performance provides the summary of our profit and loss with per share measures, which I won't speak to in detail given most line items have already been covered. Earnings per share of negative 4.4 cents was down for the half, with the improvement in operating earnings offset by lower fair value movements, as well as the higher number of shares on issue following the February equity raise. On slide 34, as announced earlier this week, we've successfully completed a full refinancing of our syndicated loan facilities. This extends our weighted average maturity to nearly 5 years, with no maturities until FY31. To achieve this, we received strong support from our lending group, who have recognised the turnaround that is underway at Ryman by providing funding out to 7 years. Our new ICR covenant is 1.5 times adjusted EBITDA to interests, excluding interest on development debt. This designated development debt includes our committed developments that are in flight, as well as recently completed care centres in New Zealand. Importantly, our existing covenant waiver remains in place, with first testing of the new covenant to apply from September 2026. Overall, this refinancing retains significant funding headroom of over $500 million and provides a strong foundation to support our strategy and long-term value creation. Finishing my sections, I'll talk to Treasury Management on slide 35. Since the equity raise earlier this year, we have delivered annualised interest savings of around $67 million, driven by lower debt, positive free cash flow, and a reduced cost of funds. With nearly 70% of drawn debt now on fixed rates and an average hedge tenor of 3 years, we have strong interest cost certainty. Combined with a lower debt profile post-equity raise, this positions us for substantially reduced interest going forward. Before I hand back to Naomi, I would like to thank all the operations teams across Ryman's villages, as well as the development and support teams in Christchurch, Auckland and Melbourne that helped deliver these results. I'll now hand back to Naomi to talk to our outlook.
Thanks, Matt. On slide 37, we have updated our full-year sales guidance to 1,300 to 1,400 RV units. This reflects expected broadly flat total sales half on half in a mixed market, with new stock delivery weighted to the first half and a lower level of new sales. In these numbers, we haven't assumed a recovery in the Auckland market, which makes up approximately 30% of our portfolio by value. We have increased our cost-saving target for the year to 50 to 60 million annualised. We have also confirmed the top end of our build rate guidance for the full year at 330 units and beds. And we have moderated our CapEx guidance, reflecting the release of contingency on a number of in-flight projects which have completed, as well as some cash timing impacts. And we take a more disciplined approach to sustaining CapEx in the existing villages. Slide 38 gives you an update on the strategic priorities we announced at the time of the equity raise and what we said would be our focus in FY26. I won't step through the slide as we have already covered each of these points through the presentation. We have made meaningful progress in releasing cash from the business, improving our performance, and resetting the business for a return to disciplined growth. Let me wrap up on slide 39. Our near-term focus continues to be on building our sales momentum, releasing cash from the balance sheet and driving operational efficiency across the business. Ryman is positioned for significant cash flow growth as the housing market recovers, aged care funding reforms are enacted, our ageing population grows strongly on both sides of the Tasman and aged care scarcity increases. And I'm looking forward to sharing more with you at our Investor Day in February on our refresh strategy, focused approach to growth, and new capital management framework, including our new dividend policy. I'll now open up for Q&A.